Welcome to ForexTV.com's PM Exchange. It's Monday, January 28th. I'm Remy Hokie. Today I'm joined by Joel Kruger, Senior Currency Analyst at Thomson Financial. Good afternoon, Joel.
Hi, Remy. Good to be back.
Great to have you on the show today.
Nice to see you.
Well, we're starting out the week with the U.S. dollar weaker against the euro, and U.S. equities have ended today's session higher, but the market is focusing on Wednesday's Fed rate announcement. The FOMC meeting begins tomorrow, and the market is pricing in at least 25 and possibly 50 basis points. So given these expectations, Joel, what do you expect to see in movement for euro dollar?
Right. Well, the euro is right now, as it usually is, you know, with what's going on with the volatility in the markets, it is at an interesting point. We're trying to, grapple with whether we're going to go up to 150 or whether we're going to start to head lower. Right now, the market's pricing in a 70% chance of a 50 basis point cut, and as we've seen over the last several months, it seems to be that the Fed normally, plays the hand of whatever the markets sort of dictate that they want, where they want them to go. If the Fed does cut 50 basis points, there's two ways to look at that in terms of price action, and really it comes down to technicals to determine which way you should be trading this. If the Fed does cut 50 basis points, there's the one side of the coin, which is the yield differential side of the coin, where people, again, they look to the attractive yield differentials that are widening in favor of the euro, and then you look to play that to the long side and possibly go up to 150. However, cutting 50 basis points, again, brings back these words that we saw a long time ago in calamity with the Fed and the sort of the times that we're in and the crisis we're in, and that suggests the fact that maybe the Eurozone, they've been very focused on inflation, and they haven't really been focused on worrying about what's going on in the markets. Maybe they're very behind the curve at this point, and if the market starts to stress a little bit and panic mode sets in, then the euro is really vulnerable to coming off, which is where I hold. Over the medium term, I do think that the euro is susceptible to a larger sell-off.
Well, Joel, you mentioned inflation, and earlier in today's session we got comments from BOE's MPC, Blanchflower. He mentioned inflation, but he said at this moment in time, worrying about inflation seems like fiddling while Rome burns. That was an interesting comment.
Yeah.
But we saw that sterling strengthened against the dollar, which is interesting given UK fundamentals. But in the short term, are you bullish on sterling?
No, I'm not. I think that I think I happen to agree with Blanchflower. He was actually the only person who voted against leaving. He was in favor of another cut at the last meeting. I think he's right on. I think again, the BOE and need to be aware of what's going on with the UK economy. Last week there were some developments. Up until last week, the BOE seemed very dovish. They were going to be cutting rates aggressively into this year, and then all of a sudden last week you had King come out, you had the BOE minutes, and then Governor's sentence. All of them came out sort of expressing a more balanced, if not more similar to that of the ECB, focusing on inflation, not worrying so much about what's going on, aware of what's going on in the markets, but at the same time needing to be focused on inflation. I think that caught the markets off guard at the end of the week, and they absorbed that, and that's why you saw the sterling strength. You saw that react in the price action. But again, I think that ultimately, technically, we've been coming down. We have rolled over the past several months. Cable is in this downtrend. I think that you're going to continue to see weakness, and really, I think it's just a question right now of we're in the process of more of a correction. Possibly we even go up to 201 area, but ultimately, over the medium term, I definitely would be looking to sell cable on rallies.
Okay, well, let's shift our focus right now over to the Japanese yen. Due to the fact that U.S. equities have gained in today's session, we've seen the yen crosses lifted due to this. But Goldman Sachs earlier said that Japan is in a recession, and we've been seeing weakness in that economy. So given that we've been seeing an unwinding of the carry trade, what's your forecast for the yen crosses? Yeah, I continue
to see weakness on the yen crosses. If you pull up a chart with any of the yen crosses, if you look at Euro yen or if you look at Aussie yen, they all show a similar pattern. They all show, we have been moving down. We've been making a series of lower highs and lower lows, and right now it's just a function of the fact that we're going up a little bit, but it's just we're still within that lower high, lower low, sort of moving in a downtrend. So I think it's just a question of finding that lower top right now. We're trading up to a lower top, and then we're going to start to move back down. So my outlook for the end crosses is to continue to see downside on the end crosses, all of the end crosses, and I think that in light of what's going on in the markets, and I think that volatility, it's one thing that people don't realize right now, or a lot of people are underestimating. The carry trade in years past, when it was so successful, it was so successful because vols were at low, they were at all-time lows, or they were fairly low levels, and that made the trade very attractive to investors. It was a low-risk trade that was yielding you a nice return on a day-to-day basis. Today, the carry trade doesn't offer that same appeal. You have volatility at extremely high levels, so it makes it a lot less attractive. So again, the trend right now is down, and I would continue to be looking to play the yen, long the yen, and short the yen crosses.
Well, we've been seeing a volatility across all markets, equities, bonds, as well as commodities. But taking a look at precious metals, we saw both gold and platinum hit record highs in today's session, both on U.S. dollar weakness as well as production concerns in South Africa. But as a result, we saw Aussie boosted by the rise in gold, and Kiwi also gained against the U.S. dollar. But given the decline we've been seeing in the Baltic Dry Index as well, how does this weigh on your forecast for the Aussie and Kiwi dollar?
Again, my forecasts with Aussie and Kiwi are aligned to the yen crosses. I do see them going lower. I think right now we're in the process of correcting. A lot of the money, the real money, and the good size is now looking to sell Aussie and Kiwi at these levels. What we have right here is a slowdown, and if this persists and you get this global slowdown, countries like China and India and Russia and Brazil, countries that that have been growing, these emerging market economies, and China, who's been consuming a lot of Australia's product and New Zealand's product, if they slow down, they're not going to need those products aren't going to be, those commodities aren't going to be as much demand. So I think that what you have here is a question of it's timing. When is this going to happen? But Aussie and Kiwi, again, as demand slows, you're going to start to see that impact their economy and impact their monetary policy, which right now they have been. Their results have been good. The economy has been really relatively robust, and Australia specifically, and they have sort of indicated possibly hiking rates. But as things start to slow, I think you're going to see that material shift in their policy. So again, we're seeing moves higher right now. That could also be related to the fact that gold is a hedge in sort of times of crisis, and certain currencies might benefit because of that. But ultimately, you have a higher yielders in Aussie and Kiwi, and they should suffer, in line with the yen crosses as well as risk goes up.
Okay, and last but not least, looking at the end of this week, we have non-farm payrolls on February 1st, and that is also a big event risk. But we also have Q3 advanced GDP, Q4 advanced GDP coming out before the Fed rate decision. So out of the key data releases coming out from the U.S. this week, which ones do you think will be most important? And if you could briefly give us your consensus forecast.
Well, I think the jobs report is going to be important. People have tended to look to that, in terms of gauging, what's going to be, how the U.S. economy is doing, and again, our consensus, we're sort of in line with the consensus, which is about 55,000. I think GDP will also, you have these ongoing debates about whether we're in a recession, whether we're not in a recession. So, definitely these numbers are going to, highlight, or help to support whichever, argument. Whichever side you're on, but I think that the market will be focused on those two numbers. But obviously, most importantly, the Fed on Wednesday is going to be the key data, the key thing, the event risk to watch this week.
Okay, Joel, as always, thank you very much for coming on the show.
My pleasure. Good to be here.
This has been your Forex News with Joel Kruger from Thomson Financial. Next up, we have your equities and commodities wrap up for the day. U.S. stocks ended the session with strong gains. The Dow scored a triple-digit gain, and the major indexes were up over 1% on the day. Equities gained as the market anticipated a rate cut from the Fed Reserve on Wednesday. In U.S. data releases, new home sales tumbled a record 26.4% last year. Meanwhile, the median price of a new home rose a mere 0.2%. The Commerce Department reported that the December figure fell by 4.7% after the 12.6% decline in November. At the closing bell, the Dow Jones Industrial Average surged 176.72 or 1.45% to end at 12,383.89. The Nasdaq gained 23.71 or 1.02% to 2,349.91. And the S&P 500 rose 23.36 to close at 1353.97. In the fixed income market, Treasury bonds were lower. Gains on the equity market and the tier note auction weighed on falling Treasury prices. The auction of $24 billion in new tier notes attracted a lower than expected number of foreign buyers. At the close of the bond market, the benchmark 10-year Treasury note fell with its yield up at 3.58%. The 30-year long bond fell with its yield up at 4.28%, and the 2-year note declined with its yield unchanged from Friday's figure of 2.19%. Taking a look at energy, NYMEX crude oil futures ended the session up above $90 a barrel after pairing earlier losses. The March crude oil contract hit an intraday low of $88.78 a barrel, but ended the session up by 28 cents at $90.99 a barrel on the New York Mercantile Exchange. Other energy futures rose today, with February heating oil futures gaining 0.74 cents to close at $2.5265 a gallon. February gasoline futures added 0.71 cents to close at $2.3253 a gallon. Meanwhile, February nat gas futures climbed 11.2 cents to settle at $8.095 per million BTU. Over in the metals complex, gold and platinum futures hit record highs on the day. U.S. dollar weakness and production concerns pulled prices to new highs. A power crisis in South Africa led to the derailment of mining output as well as production. COMEX gold hit a record of $929.80 an ounce, and the February contract ended with a gain of $16.40 or 1.8%, closing at $927.10 an ounce. Platinum futures also hit a record at $1,733 an ounce. The April platinum contract added $48.60 on the day to close at $1,728.70 an ounce. Elsewhere on the NYMEX, March silver gained 26 cents to close at $16.75 an ounce. March copper added 0.55 cents, ending at $3.1895 a pound. This afternoon, we're joined by James Mound from James Mound Trading Group and author of the Mound Report. He'll give us his commodities outlook for the week ahead.
This is James Mound for MoundReport.com with the week ahead for the week of January 28th. Last week, the volatility was at an extreme high, but it's just the beginning of what's to come. This is what we would call the Super Bowl week in more ways than one. Today, we start out with new home sales, which rocked the market south, but we've seen a strong recovery intraday. And we're leading into tomorrow's first day of the Fed meeting, and then a blockbuster Wednesday where we get the GDP report, energy stocks, which is almost a non-event at this point, and the second day of the Fed meeting and the announcement that comes thereafter, 2:15 p.m. Eastern Time. And then Friday you have the big monthly employment report. With this type of multiple report week, oftentimes there's so much volatility energy going into it, and a lot of it is let go once the announcement comes out. So you might see a bit of a batting head environment because the odds of the GDP report, the employment report, the Fed meeting, the State of the Union address tonight, all these things pointing in a one-directional trend are very small. So play this volatility, play the chop. Look at things like the euro today up 111 points as I speak. Sell into that rally. Expect the dollar bounce this week. It goes a bit contrarian, but it's most likely going to occur this week. I expect to see the dollar up testing 77 by at least midweek next week. The S&P 500. Don't get fooled by the Fed meeting this week. The bottom line is it doesn't matter what they do. Quarter point, half a point. It really doesn't matter. This market is going to have a negative reaction to it because the simple truth is the market doesn't believe the Fed is in control. And whenever that happens, it doesn't matter what they do. There's going to be enough critics that come in and say it's the wrong move. It's going to create some selling pressure in the stock market. So I'd look at this as a great opportunity to get into some bearish spreads. On a technical level, it's holding a consolidation pattern and overall is still very bearish outlook in that market. In other markets, take a look at sugar. This is a market that had an extreme rally to 13, sold back off. The main reason for the rally was a short covering buyback from this guy who just went under out in Brazil. But they have a lot of reasons to push this market higher at this point. Not only do they have volatility and short covering, but you also have news out of India. They're 2 million tons short on their crop this year. That is a major number that came as a bit of a shock and could be a turning point fundamentally for that market. Take a look at some call plays there. Should pay off in the long run. Gold, silver, crude oil, these are all markets I'm looking to see some selling pressure in as the dollar gains some strength this week, especially gold, which is at an extreme overbought high. This is the largest 6-month move we have seen in over 25 years on a point basis and on a percentage basis. We're up almost 45% in gold right now in the last 6 months. It's one of the largest 6-month moves ever. So take a look at buying some put options there. The premiums are elevated because there's a lot of buying of options right now, but it's the right move, and it should continue to benefit from volatility in the actual direction that we're playing it in. That'll do it for me, James Mount, mountainreport.com in the week ahead. We'll see you next week.
That was James Mount from James Mount Trading Group with his commodities outlook for the week ahead. And that wraps it up for today's edition of PM Exchange. I'm Remy Hoki. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.